When it comes to investing, what would you say the most common questions are that you get asked?
There are other questions to be asked. At what age do you want to retire? How much income do you want out of your pension? During your retirement years, what's inflation going to be? Finally, at what age are you going to die?
It seems there's no easy answer, so
No.
you have to take a whole view, don't you?
You do, yeah, you do.
Imagine they could do it themselves, but they probably wouldn't get the same level of result.
We've got to learn what their objectives are, what are they trying to achieve, and to put a plan together to help them achieve that objective.
All very good questions, but very difficult to answer.
Yeah, impossible to answer. There's so many variables, it is just about trying to get as much in there as you can to give you choice in the future.
Hi, I'm here with Bob. Bob, would you mind just introducing yourself, who you are, where you work, and what you specialise in, please?
Yeah, okay. I'm Bob Brehaut. I'm a director of Oakley Independent Advisors. We're an IFA and mortgage firm based in Droitwich. I set the firm up 27 years ago as a whole-of-market independent financial advisory firm.
Fantastic. So when you say whole of market, we're talking pensions, general investments, mortgages.
When we talk about whole of market, it's the fact that some IFAs are really restricted advisors, so they can only use a limited, maybe investment platform. They've only got a choice of one. So although a lot of their other work can be independent, as far as the regulator's concerned, they are restricted, and it's very difficult for the client really to understand the difference between whole of market and restricted advisors. They will look very similar.
Okay.
But we have no restrictions placed on us. We can invest with anybody we want on any platform in any wrapper.
So I could come to you with an ISA and you could put my money in the ISA through funds with HSBC, BlackRock.
Yeah, when I say I can
Mark.
use any platform or company, it's of those that will deal with independent financial advisors.
Okay.
So people like HSBC are tied generally because they want you to have to deal with them. Yeah.
But certainly, I think what you're saying is if I came to you, there's a lot more flexibility in what you could do for me.
Choice. Yeah, a lot more choice in what I can do for you.
Okay. It's good to know. So when it comes to investing, what would you say the most common questions are that you get asked?
Okay, I would say there's two.
Right.
So the first one would be, how much do I need in my pension? It's a very popular topic at the moment. If you look at YouTube, Instagram, there's lots of gurus on there telling you how much you need and how much you can take out.
Yeah.
But from my point of view, the answer is, it depends. There are other questions to be asked.
Okay.
So those would be, at what age do you want to retire?
Yeah.
So you're going to retire at 55 or 70? How much income do you want out of your pension? Some people might want £2,000 a month. Others might want £4,000 a month. During your retirement years, what's inflation going to be? And finally, at what age are you going to die? Yeah, all those.
All very good questions, but very difficult to answer.
Yeah,
Yeah.
Impossible to answer. So, how much do I need in my pension is impossible to answer because it depends. So, what I say to people now is, you need as big a fund as you can get by the time you decide you want to retire. So a pension, in effect, all it's doing is giving you choice. It's giving you the choice that at some point in time you go, well, I could slow down now, I could stop now. Yeah. Also, your pension income might be different. If you're 55, 65, you might want a higher level of income up until age 75. And then because your health deteriorates and you're not going on so many holidays, then potentially your income needs might reduce.
Yes. Yeah.
Yeah. And then later on might increase because you need to go into a care home. So there's so many variables. It is just about trying to get as much in there as you can to give you choice in the future.
Yeah. So in today's money, so let's say we have a 65-year-old today with three 65-year-olds, one with 250k, one with 500, and one with 1 million in the pension pot, who needs that money for 20 years. Presumably, the millionaire pension pot pays a lot more, but how does that work with income tax and inheritance tax and things
Well,
like
you've got
this?
three choices when you get there.
Yeah.
Yeah, three combinations. One is that you buy an annuity. So you take your 25% tax-free cash.
Mm-hmm.
The residual fund then you give to a provider, and they give you a set income for the rest of your life
Right.
based on what your perceived needs are at that time. So do you want it just a level payment for the rest of your life? Do you want it to increase with inflation? What rate of inflation do you want to use? Do you want to use 3%, 5%, RPI? Do you want the pension to die with you, or do you want your spouse to receive 50% of the pension for the rest of their lives? Again, there are lots of combinations if you're buying an annuity.
Mm-hmm.
But what you're doing with that is you're taking out the investment risk, and you're also guaranteeing that you'll never run out of money. With
What?
inflation, though, that could be not enough money if you've taken a level payment and you live a long time.
Mm.
Yeah. The second choice, if you don't buy an annuity, is to go into income drawdown. So the money remains invested and you draw down your income needs from the pot on an annual basis,
Yeah.
which can vary every year. Yeah. The problem with that is investment risk. It
They
might
can
not
go.
grow as much as you're taking out.
Yeah.
It could actually go down in value, and ultimately you could run out of money before you die.
Yeah.
The third option would be a hybrid model.
Mm-hmm.
So you buy an annuity with a percentage of the funds to give you a minimum income to be able to pay the day-to-day bills, and then the more luxuries in life you draw down out of the drawdown funds, and when it's gone, it's gone. If it goes, depends
Yeah.
on how much you draw down.
Okay. And you said there was a second common question as well.
Yeah, the second common question is timing when you invest in the market.
Yes.
Yeah. So at the moment, the market is classed as inflated. Oh, now's not a good time to invest. I'll wait for the correction. Yeah. But the unknown question is, will there be a correction? Have we got a problem with AI, or will the AI bubble continue to grow?
Don't
So,
they say that if you had invested just before a large crash and didn't take your money out, that and you left it there for 10, 20 years, you're still going to be better off by having spent
yeah,
the time in the market?
yes. So, an example I've got is a client that came to me, aged 55,
Mm-hmm.
worked for a multinational company, decided he couldn't do the job anymore, he needed to retire. Got some advice with another firm to transfer his occupational pension into a personal pension, which again, there's debate over whether that's a good thing to do or not a good thing to do. I'm not authorised to give that type of advice, but he ended up with 1.4 million in his personal pension. Came to see me, got this 1.4 million, Bob, needs to last the rest of my life. I've been recommended to you, can you invest it for me? Yes, we did. After the first month, he got a letter telling him the fund had fallen by 10%, 140,000. He phoned me up, he said, I've had a letter, it says I should ring you. What am I ringing you for? I said, because your fund's gone down 10%. And he said, yeah, but you told me it might, and it has, and you've told me it'll recover. So I'm happy, I'm not bothered. Okay, that's fine. Next month, he got a letter telling him it had fallen 20%. He didn't ring me. When he came in for his annual review after 12 months, he was up 6% on the original 1.4 million.
Yep.
Yeah. Now, that guy's been with me 6 years. He's drawn money out every year as income. The last 12 months, he said to me, Bob, I want $5,000 net, yeah, in my account. Can we afford that? And I said, yep. So he had $5,000 a month net. When he's come for his annual review after 6 years, his pension pot is still 1.4 million. And I have to tell him what I'm charging him in fees every year. And he says, Bob, in my opinion, you're worth every penny. He said, I retired with a group of guys at the same time. I still see them down the pub. They all told me I was mad to pay financial advisor fees. I'm the only one that's still got 1.4 million in my pot. Everybody else has lost money. He said there's one younger guy than me. He had 700,000 and he's just had to go back to work because he spent it all. Yeah. So with timing the market, with trying to time the market, you can't do that. The industry has a phrase that says it's time in the market that matters, not timing the market. You've just got to put it in there, and providing it's for the medium to long term, the growth will go from the bottom left to the top right, but there'll be some bumps along the way.
And what would you define as the medium to long term?
It must be for a minimum of 5 years. Yeah. Anything over 5 years is medium term, and you should be fine. Can't guarantee it. Yeah.
Yeah.
But, when I'm talking to youngsters that have got 10, 15, 20 years or more to go, you need to be in the market.
And how does being in the market compare to just keeping money in a cash ISA?
Cash ISAs can do good.
Yeah.
In recent times, we've seen decent returns from cash ISAs. That's probably down now to 4%. And as interest rates fall, that will come down. From our point of view, we have to talk about attitude to risk with clients. I think personally, risk is probably a bad word. It's a word that puts people off. I think that word ought to be changed to attitude to volatility.
Yes.
Yeah, the fact that how prepared are you for your fund to fall? Yeah, if we look at the last dip we had in the market, which was Liz Truss crashing the bond market, everything fell 20%. The cautious stuff stayed down for longer because it was the gilts that were crashed. Yeah, the stocks and shares recovered quite quickly. I think attitude to risk is attitude to volatility, which affects interest rate returns. So if you're cautious, you might get a 3% return on your investments. If you're balanced, you might get a 5% per annum return on your investments. And if you're adventurous, you might get a 7% return on your investments. But you are typically invested in the same funds. So if you look at a portfolio, you'll have the same makeup of the portfolio. It's just the percentage that's in the stocks and shares that will increase. So a cautious fund might have 20% equities. A balanced fund might have 40% equities, and an adventurous fund might have 60 to 80% invested in equities, and that's where the growth comes from, but also where the volatility comes from.
I suppose the bonds are there to
Give the stability.
stability. That's the word.
Yeah.
Yeah. So, depending on a person's age and place in life, I suppose you'd be going for cautious through to more
Yeah,
adventurous,
it's
depending.
interesting. I mean, attitude to risk has to be assessed on different things.
Yeah.
So it is about how long you're investing for. It's how concerned you are with volatility. It is about what age you are. Yeah. It is about how much risk you need to take to achieve your objective. So if you've only got a small need for growth,
Yeah.
the argument is, why are you taking the risk when you don't need to take that risk? Yeah. So you could become more core. And again, it's time frame. So you might be an adventurous person, but you're going to need that money in 2 or 3 years' time.
Yeah.
So you would move it potentially into more cautious funds to make sure you don't get the volatility at the time you're wanting to in cash.
Yeah. So, just to summarize, to make sure I'm understanding, if I were 60 looking to retire in the next few years, I might think of putting things into safer assets, which you said are things like bonds.
Depends.
Ah.
Everything depends. If you're looking to buy an annuity,
Yeah.
then yes. If you're looking to go into drawdown, then retirement age is just a point on the graph.
Right.
So you would continue in whatever strategy you've got because you don't want to take it all out at that point. You actually are maybe only taking out, 5% of the total fund. What you might do is you might move 5% into something cautious, 5% into cash ready, in case of some sudden volatility like Donald Trump goes into Iran, yeah, because that affects the market.
Yeah.
But in the medium to long term, I mean, we've already recovered from Donald Trump going into Iran, and the market is higher than it was before he went in. Yeah. So you've just got to look at a strategy of, when am I going to need the money? Does it matter if it's volatile at that time? And that's something you would discuss with your financial advisor.
It seems there's no easy answer, so
No,
you have to take a whole view, don't you?
you do, yeah, you do.
Yeah. So you gave one example already of a real life advice and scenario. Do you happen to have another one, or that you could share just for interest?
Um,
We can revisit that if
yeah,
something pops to
yeah,
mind.
yeah.
So from your experience, how would, because obviously I'm a conveyancing solicitor and property's my
Yeah.
area of interest. How would a property purchase typically fall within someone's wider financial goals?
Okay, so again, if we go back to pension planning,
Yeah.
you're looking to retire. From my point of view, I think it's very useful to have bought a house, paid your mortgage off by the time you retire, so that commitment stops, and any pension that you've got or any other investments you've got are funding lifestyle needs, paying the gas, electric. The typical pension pot in the country at this time is around about £100,000.
And sorry, is that for someone who's freshly retiring or
Yeah.
including everybody, younger
That's
people?
no, that's people retiring in the UK at the moment. But it's around 120,000.
That's a big number, but it doesn't sound like it's going to do much on a monthly basis.
No, when you take your 25% tax-free cash out,
Yeah.
you've then got 75,000 plus to provide an income for the rest of your life. Yeah, which is
I'm
not
gonna
going to do a lot.
No,
Now,
I was
if
gonna
you're then
say.
relying on state pension,
Yeah.
which is 12.5 grand a year, that's probably going to cover the rent. Yeah, you've then got nothing to live on. So
And that's why it pays to be in
if
a
you
in
if
your
you
own
own the
house.
property.
Yeah.
Now, people with more money, again, I've seen stuff on YouTube where you can sell your £900,000 property, invest the money, get a 9% return, and that's going to cover your rent. Yeah.
Hmm.
My question then is, well, how are you going to live on the 900,000? How much do you need to live? How much do you need to leave in the pot to be able to pay the rent every month? How much can you actually spend?
Yeah.
Yeah. And the dilemma a lot of pensioners have is this fear of running out of money. Yeah.
Yeah, I can understand because they're not going to work anymore for a fresh income.
Yeah.
They've only got what
They've
they've
got a
got.
they've
Yeah.
got a they've got a pot of money that isn't being topped up.
Hmm.
They don't know what inflation's going to be. They don't know how long they're going to live. Yeah. So they're scared of spending it. So they restrict what they're spending.
Yeah.
Yeah. And one of the biggest discussions I have with some of my clients is you need to spend some money. Yeah. You need to enjoy life more. You're just not spending it. You're sat in this bubble, worried
Hmm.
about how long it's going to last. Yeah.
Yeah.
So if you're even if you're paying rent out of this sum of money, you don't know how much you can spend because you don't know how long you're going to have to pay the rent for. So another example I've got is a guy that used to work for me that retired
Yeah.
and decided to move back up to Leeds with his wife. They owned a property locally,
Hmm.
and I heard that he was going to move to Leeds and rent. Yeah.
Right.
And I actually said to him, can I just come round and have a chat to you and your wife? I'm not going to charge you. So I went round to discuss it with him and explained that, well, you've got this pot of money now to pay the rent. What you don't know is how long you're going to live. How much of that fund are you going to put away to pay rent for the rest of your life? And how much are you going to be able to spend on other things? Which, of course, he didn't know. And his wife said, that's the biggest concern I have, Bob. I don't know how to manage money.
Hmm.
Yeah. And I said, my advice would be go and buy a smaller house in Leeds that you own so nobody can kick you out because they've decided to sell the property. Yeah. Nobody can put the rent up.
Yeah.
And having spent that on a house, you then know how much money you've got to spend for the rest of your life.
And I suppose owning that house gives you a great feeling of security.
Security,
Yeah.
definitely. Security, yeah. And that's what they actually did.
Mm.
Yeah. They moved to Leeds. They bought a little bungalow, and I haven't seen them since.
So it almost sounds that you're saying that the people owning a residential house that they live in as a part of their wider financial goal is almost like setting a foundation or a basic building block to build everything else upon and give that
Yes,
stability.
I think so. I mean, we've seen in the rental market recently that supply has been reduced because landlords are put off being landlords and have sold the properties.
Yeah.
So finding a property is very difficult. There's lots of applicants for that house. That drives up rents.
Hmm.
Yeah. So if you've paid a mortgage and you own the property, you haven't got any of those worries anymore.
Yeah.
At a time when you get to the age where you start worrying more.
Yeah. Okay. Is there anything else that you would like to sort of expand upon that we've mentioned or um, get into? Any other interesting topics?
Well, I think it's the other question that people come up with all the time is why should I use a financial advisor? Why can't I do it myself?
I imagine they could do it themselves, but they probably wouldn't get the same level of result.
No, it's a bit like doing your own car mechanics.
Yes.
I could do it myself. The last time I tried it, I ended up with some spare parts. Yeah, which investing, yes, you can invest, but I
Yeah.
don't even invest my own money myself. I give my money to somebody else to invest for me, because typically you make wrong decisions when you're investing your own money.
Mm.
When the market moves down 10%, you move it, yeah, which is the worst thing
And
to
then
do.
you've
You move it into
realised the
something else
loss.
that then falls another 10%,
Yeah.
yeah. So you're better to pay somebody to make those
I
investment decisions for you.
suppose they can talk you off the edge from selling at a loss and keep
Yeah.
you on track.
Yeah, anybody that sells when the market goes down, all they're doing is consolidating their losses.
Yeah.
So hopefully a financial advisor gives you much more than just the investment advice. He's giving you life skills, helping you make difficult decisions that you've never had to make because you've never been there. But the financial advisor has seen it with lots of clients in the past and can pass on that knowledge and help you
Hmm.
carry on with a plan to get to your ultimate goal.
Yeah. So if I'm acting for a client buying, selling a house, let's say selling, they've come into some money that has been released from the house, whether it's a buy-to-let property or an inheritance. What would be the benefit of me saying you should have a word with Bob? How can you help those sorts of people?
Well, whether it's me or just another financial advisor, it's a
Yeah.
fact of we've got to learn what their objectives are, what are they trying to achieve,
Hmm.
and to put a plan together to help them achieve that objective. So it could be pension planning, it could be investing, it could be a combination of the two.
Yeah.
It could be gifting for inheritance tax.
Yeah.
It could be gifting to the family. It could be putting money into trust for children. It could be just topping pensions up or investing into ISAs, anything like that, really. So it's just looking at a holistic picture of the client,
Yeah.
attitude to risk, capacity for loss, what happens if the value goes down, and overall objective, and putting together a plan.
That's fantastic.
Okay.
Yeah. Thank you. So thank you for coming today. I think we've
Thanks for
covered a.
inviting me.
Thank you're very welcome. It's been nice to speak with you and pick your brain on all the financial offerings that you have.
Okay.
So yeah, thank you for coming. It's been great, and we'll see you next time.
Okay. Thank you very much.